Why does the cost of goods sold keep changing, even for the same sales transaction? Why do your inventory values shift days or even weeks after the sale is posted? In this video, we are going to break down one of the more confounding areas in ERP systems, inventory valuations. Specifically, we'll show you how Dynamics 365 Business Central calculates inventory cost, why those adjustment entries appear, and how you can interpret what's happening under the hood. Whether you're a controller, cost accountant, or ERP consultant, understanding this can help you close books faster, avoid margin errors, and troubleshoot cost issues with confidence. In Business Central, the cost that's used when you sell or consume an item is often just a starting point. Depending on your inventory valuation method, and we will go into each one in full detail, that cost may need to be recalculated later to reflect how costs are averaged, layered, or compared to a standard. That's why the system runs a separate adjustment step to ensure the final cost matches your chosen method. To handle this, BC uses a two-step process. First, it posts the transaction using the current unit or standard cost on the item card. Then it runs a separate process to calculate and post adjustment entries, if needed, to align the transaction with the actual cost, whether that means applying the correct cost layer, updating the average, or accounting for a variance from the standard cost. Business Central, we have two ways to run the cost adjustment process, each with different levels of control and system impact. Option 1 is to enable the automatic cost adjustment setting in the inventory setup screen. So you access the inventory setup screen and make sure that the automatic cost posting is turned on. With this setup, BC will calculate and post cost adjustments immediately after each transaction. This keeps your inventory and cost of goods sold aligned in real time, but it can slow down posting performance in high volume environments or during bulk operations. Option 2 is to run the scheduled adjustment through a job queue. For this, you turn off the automatic cost posting setting. You will get this notification about setting up a job queue to schedule these adjustment entries. You can go from this notification and schedule these cost adjustment entries as well as the posting to the general ledger. Just turn these on and then you can edit the time at which they should be run. Once you click finish, the two job queue entries will be created and they will run at the time that you have specified. This is ideal for companies that want up-to-date costing without impacting performance during the day. Most companies run this overnight or after hours. Whichever option you choose, the important thing to remember is this: Business Central does not always finalize the cost when the transaction is posted. So adjustments are expected and play a key role in keeping your cost data accurate. Let's start with FIFO, or first in, first out, which is the most commonly used inventory costing method in Business Central. It assumes that the oldest inventory purchased is sold first. So costs are assigned based on the earliest purchase layers. This method closely mirrors the physical flow of goods in industries like retail, food distribution, and consumer goods. FIFO is straightforward, GAAP accepted, and generally results in higher profits when prices are rising. Okay, so let's look up an item that is set up with FIFO costing. This item number 1 is set up with FIFO, as you can see in the costing method here. And this item is set up with a unit cost of $30. Let's set up two purchase orders. So we've got a couple of inventory layers to work with for this FIFO example. Need a invoice number because it's a purchase invoice. And I know it's item 1, so I'm gonna buy into the main location. I'm gonna buy 10 units of it. As we saw earlier, the unit cost is set at $30, so it's going to default to $30. So I'm going to post this and receive this product into the system. Now, to test through this, I'm going to create another purchase invoice with the same vendor and an invoice number. But this time, I am going to change the cost to, let's say, $35. And let's post it. So I have 10 units at $30 and 5 units at $35. Now, if I go back into the product master, you will see that the unit cost is now $31.67 per unit, right? So now if I go and try to sell this item, let's do that now. All right, let's do a sales order to see how the inventory valuation and the costing works. So we go and create a sales order for Bright Light Company, and we pick the item with the FIFO valuation method, and we brought inventory into the main location, so that's where we're going to sell it out of. Let's say I want to sell 2 units of this. Okay, now let's go ahead and post this, and let's ship and invoice it. Now, if we go back into the item and we go into related history entries and value entries, you will see a few things. Let's look at it. Here on the value entry screen, we can see our 2 purchase transactions, 10 units at $30 each and 5 units at $35 each. Since this item is set up with FIFO, first in, first out, you would expect that when we sell 2 units, the system would pull directly from the first $30 layer and record 1 cost entry for $60 in total. But that's not what happens. At the time of sale, Business Central uses the current unit cost on the item, in our case $31.66, to post the initial cost. Then, in the background, it applies the FIFO logic. It finds that the first available layer is $30 and posts an adjustment entry for the difference. $1.66 times 2 units, which is equal to $3.33. That's why, for a single sale, you often see 2 value entries, the original posting and an adjustment that brings it in line with the correct FIFO layer. This 2-step behavior is expected. The system separates the time of posting from the logic of final cost assignment and uses adjustment entries to make sure your cost of goods sold reflects the actual inventory flow. This 2-step behavior is expected in FIFO. The system separates the timing of posting from the logic of final cost assignment and uses adjustment entries to make sure your cost of goods sold reflects the actual inventory flow. Let's briefly talk about LIFO and specific. LIFO, last in, first out, works just like FIFO but in reverse. So while FIFO pulls from the oldest costs, LIFO uses the newest, resulting in different cost of goods sold. In Business Central, both methods follow the same 2-step process. The system posts an initial cost, then adjusts it once the correct inventory layer is applied. LIFO is commonly used in inflationary industries like chemicals or petroleum because it lets companies account for higher recent costs, which can reduce taxable income. But here's the catch. LIFO is only available in the US version of Business Central. It's not supported in localizations that follow IFRS, where LIFO is not allowed. Let's talk briefly about specific costing, the most precise inventory valuation method available in Business Central. Specific costing allows you to assign the exact cost of a specific inbound item to an outbound transaction. In Business Central, this is achieved through serial number tracking, which lets the system match each sale to a uniquely identified unit with a known cost. Just like FIFO and LIFO, BC uses a two-step process. It posts an initial cost, then adjusts it once the specific layer is applied. Specific costing is typically used in industries where each unit is high value, regulated, or uniquely identifiable, like aerospace, medical devices, or custom manufacturing. In Business Central, specific costing requires serial number tracking. You cannot use lot numbers. The system needs a one-to-one match between receipt and sale to apply the correct cost. Average costing is commonly used in high-volume industries like wholesale and distribution, where tracking individual inventory layers is not practical. Now let's walk through how Business Central handles average costing and why it behaves very differently from FIFO or specific costing. Item 4 here is set up with average costing, and it has a unit cost of $35. Again, let's create a couple of purchase invoices to create a couple of layers of incoming inventory. So let's start with the first purchase invoice. I'm going to say same vendor, put in an invoice number. Item 4 is our item with average costing. Receive it into the main inventory location. Again, let's start with 10 units at the default price of $35, default unit cost of $35. And let's go ahead and post this and receive it. Let's do one more purchase invoice. Same item, same location, but this time I'm going to get 5 units at let's say $40. And let's post this. Okay, let's now do a sales order for this item. Let's pick the same customer, item 4, same location. Again, let's do 2 units and let's post, ship an invoice. Now, after recording the sale, let's look at the value entries against this item. At this point, there is no adjustment entry because the average was already up to date. Unlike FIFO, LIFO, or specific, where the final cost can only be determined by matching the sale to a particular cost layer, average costing continuously recalculates the unit cost every time you receive inventory. That means when we made the sale, the system already knew the current weighted average and could post the correct cost immediately, with no need to go back and adjust it later for that transaction. Now, here's the interesting part. When we post another inventory receipt, something unexpected happens. Let's look at that. Let's do another purchase invoice. Same vendor, same everything, except, well, actually, we'll keep even the cost to be the same. Let's add 10 more units at $40. So the first thing that happens after the additional purchase of 10 units at $40 is the update to the unit cost. It is now $38. Since that sale happened recently, the new order that we just processed, and it is still within the adjustment window, I will get into this in just a bit, Business Central takes another look at it and says, hold on, the cost we used before was too low. So now, if I go and look at the value entries, you will see an additional adjustment entry for the difference. In our case, $2.67. So the sale now reflects the updated average cost. That's why with average costing, you can see the same sale get touched more than once as new purchases come in. In fact, if more purchases happen during the adjustment window, the same sale could be adjusted multiple times. Each time the average cost changes. This leads us to a key concept in average costing, the cost adjustment period. You can see this in the inventory setup screen. The average cost period tells Business Central how to group transactions when calculating the average cost. If it's set to day, BC calculates a separate average for each day. So a sale posted today can only be revalued by purchases dated today. If it's set to month, all purchases and sales for the month are grouped together, which means a sale posted early in the month could be revalued multiple times as more purchases come in later. Shorter periods limit how often a sales cost can change, while longer periods smooth the cost over time but can trigger more frequent revaluations. So in summary, with average costing, adjustments are driven by purchases, not sales, and even past sales can be updated if the cost changes with the adjustment window. This makes this method powerful, but it also means you'll see more frequent adjustments and need to understand the adjustment period setting to avoid surprises. Let's walk through a standard cost example to see how Business Central treats costs and why it behaves very differently from FIFO, LIFO, or average. We start by defining a standard cost on this item number 5 of $22. You can see that the costing method is defined as standard and the standard cost is defined as at $22. This is the cost BC will use for all inventory related transactions, regardless of what we actually pay vendors. To demonstrate this, let's start by purchasing 10 units of this item at $20. In the value entries screen for this item, we first see the purchase recorded at the actual price from the purchase order, $20 per unit. Then BC immediately posts an adjustment entry to bring the inventory value up to the standard cost of $22 per unit. The $2 difference per unit is sent to the purchase price variance account in the general ledger. Now, let's purchase another 10 units at $23, above the standard. At this point, we have 20 units on hand, all valued at the standard cost of $22, regardless of what we actually paid for. Now let's sell 15 units. Business Central posts the transaction using the fixed standard cost, $22 per unit. So the cost of goods sold, as you can see here, is 15 times 2, 315 times 22, $330. Unlike FIFO or average, there's no need for a cost adjustment entry because the cost is predefined and doesn't change based on purchase history. Standard costing offers predictability, but it requires tight control over cost updates and variance accounts. It's widely used in manufacturing environments where costs are planned in advance and variances are monitored separately for analysis. Thanks for watching. If this helped you better understand how Business Central handles inventory costing, give it a like or subscribe for more videos like this. In this walkthrough, we covered how BC handles FIFO, LIFO, average, standard, and specific costing, how costs are posted, when adjustments happen, and what makes each method behave differently. Understanding this is critical to managing your cost of goods sold, explaining margin shifts, and keeping your financials accurate. We didn't cover job costing, manufacturing, expected costs, or how predated receipts can impact cost adjustments. Those topics can definitely come in future videos. If you have questions about anything we covered or want me to dive into other Business Central topics, drop a comment below. I'd love to hear what you're working through. Thank you.